Another wild price smash overnight. Silver hit a low of $71 per ounce, flushing out more positions. Gold hit $4,399 before recovering. And then we got a massive bounce. Silver recovered from 71 to 83. Right now, as I'm recording this pre-market, that's a 17% bounce from the low. Gold recovered $250 of the $450 loss. From the intraday low, gold is up 7%, silver gains 15%. Pretty good, but crazy volatility. And we are waiting for the New York session to open. Mark here from GoFinance. In my previous videos, I laid out specific scenarios for silver using Bitcoin as our leading indicator. The reason is clear. When large-scale risk sentiment shifts hit the markets, crypto, and especially Bitcoin, often moves first. It gives us a critical signal for commodities like silver. My directive was to watch if Bitcoin closed the weekend above or below 82,000. I said if it closed below 80 to 82,000, expect that selling pressure to spread. It closed at 76,000. The lowest it hit was 74,500. I specifically warned that if it tested 74,000 or below, that would confirm significant weakness. Go watch the prior video. This was the cornerstone of my bearish thesis. And what happened? We experienced that exact spillover selling. Silver got hit, dropping to 71. We then saw the relief bounce, a 17% move back to 83. Now we wait for New York to open to see if this bounce holds, or if the bearish scenario resumes. I read every comment from yesterday's video. Thank you. It's powerful to see you using this information to make sharper, more confident decisions. The split in perspectives was clear. Some of you are preparing for another leg down. Others are firmly anchored in the long-term macro thesis. That division doesn't signal confusion. It shows a community of prepared individuals, each executing their own plan. That's the core of what we do here. Independent thinking, not herd mentality. We don't sell fear, greed, or hype about instant riches. This isn't a scripted show with a predetermined happy ending. It's real markets and real risk. Now, a critical reminder for everyone, especially those new here. I do not sell signals, courses, mentorship, or any paid service. Anyone claiming otherwise is a scammer. Block them immediately. My only role is to provide a clear, unfiltered view of the markets. I operate solely on X and YouTube. That is the only source for my analysis. I'm not associated with any other accounts. Protect yourself. I will never ask you for money. Now let me show you the current data, pre-market, right now. Shanghai spot is at $119.99. Shanghai futures at $114.20. Western spot at $83.47. Western futures also $83.47. The premium is $18.52. That's a 22.19% premium. This is down from the 43% premium we saw over the weekend, but it's still a 22 to 23% premium right now in pre-market. Crazy volatility, and we're waiting for New York to open. Here's what happened overnight and this morning. $10 trillion wiped out in just 3 days. Gold is down 20% from its peak, erasing $7.4 trillion in market value. That's 5 times the entire market cap of Bitcoin. Silver crashed nearly 40%, wiping out $2.7 trillion, equal to the entire crypto market cap. Safe haven assets are moving like crypto meme coins. This is the Kevin Warsh Fed chair sell-off continuing. But here's what makes this different from a normal crash. Central banks did not start selling gold. Tether did not sell its gold. The US government did not find a plan to reduce debt significantly. In fact, the US government shut down because it can't get its spending issues resolved. So why is gold puking so hard? There seems to be a disconnect between the markets that trade gold. But the real answer is someone needs liquidity and is selling gold assets, which means a lot of paper shuffling going on, because absolutely nothing in the fundamental backdrop changed since Thursday, other than maybe the banking system hit a major bump. The way gold is selling off, while equity futures and Bitcoin fall, yields dropping and the dollar starting to show some strength, this isn't normal price action. It's stress. When gold is sold like this, it usually means something is about to break. This is a liquidity crisis. In a true margin call event, funds don't sell what they want to sell. They sell what they can sell. Gold and silver are liquid, profitable positions for many, making them the first piggy bank to get smashed when the margin clerks come calling. Before we continue, if you're finding this analysis valuable, drop a comment below. Tell us where you're watching from. Are you in the US, Europe, Asia? And what do you think? Bottom or trap? Subscribe to GoFinance if you haven't already. Now let's get into the smoking gun. Now, here's the smoking gun that proves this is paper manipulation, not physical fundamentals. People in Singapore and Australia are queuing to buy gold, not silver, because silver is broadly sold out. In Hong Kong and China, no queues reported, simply because premiums are wide and supply is scarce. Silver broadly sold out there too. In Europe, dealers pulled their offer on silver entirely. People were still queuing up to buy gold in Singapore. even as prices plummeted, showing the extraordinary resilience in retail demand for precious metals. If this were a real bear market, if the world truly didn't want precious metals, nobody would be queuing, nobody would be competing for inventory. Dealers wouldn't be pulling offers because they have nothing left to sell. The opposite is happening. Physical demand is increasing while paper prices collapse. That's not a bear market. That's manipulation. The reserve in Singapore, one of the world's largest private silver vaults, says physical silver demand increased during the crash last week. The reserve sees a growing divergence between paper and physical markets and expects physical shortages to get worse. Meanwhile, the current price of silver on China's largest e-commerce platform, JD.com, is $163.35 per ounce today. COMEX is at 83. That's a 95% premium. Let that sink in. JD.com 163, COMEX 83, 95% premium. And silver is still in backwardation. You can't cure a huge physical shortage by manipulating the paper price. The manipulation has nothing to do with physical supply and demand. It's to prevent a Western financial crisis, due to choices made by those in power. Incredibly obvious. Whatever is going on behind closed doors must be truly big. Silver remains in backwardation. That means there is a shortage of physical metal, and all these shorts will have to make physical delivery eventually. They are playing a very dangerous game this time. We are in a precious metals revaluation process. COMEX and LBMA are being drained of physical gold, but especially silver. All the shorters now care about is low paper prices, while trying to cover paper shorts and minimize losses. But at the end of this process, the full revaluation will unfold, and silver will be trading much higher, especially when you look at the ratio. The gold to silver ratio needs to reach at least 15 to 1 historically. We are at 57 to 1 right now. That gap has to close. What's striking is how net volumes on silver futures at COMEX continue telling a completely different story than the price action. Yes, they tried to crash the price all last week, and they succeeded, but the overall volumes are so far almost balanced outside the large, heavy dumps. It means the price is being driven lower by a combination of spoofing, mostly during overnight hours, and wash trading during US trading hours. Because the price was being forced lower, that triggered derivatives unwinding on large ETFs like SLV, but especially AGQ, creating the flush through stops. Needless to say, this has nothing to do with the physical market, where fundamentals remain unchanged and the physical shortage keeps worsening. SHFE silver vaults are stable. The Shanghai gold parabola is still intact, but it needs to bounce here. SHFE silver futures hit the daily limit down 17%, causing the contract to lock at the lower price limit, with heavy one-sided selling and very limited or effectively no two-way trading for the remainder of the session. That tells you the Chinese market is under stress too. But the physical vaults are stable. The premium is holding. Physical is not breaking. Only paper is breaking. Now about 75% of you watching aren't subscribed. If this unfiltered real-time analysis is cutting through the noise for you, hit subscribe. If it adds value, drop a comment below and tell us where you're watching from, and whether you think this bounce holds when New York opens. I'm here for those who want clarity and substance, not polished hype. Now let's talk about what New York could bring. 2 scenarios for the New York Open. Let me walk through both clearly. Bearish case first. If New York opens and the selling pressure continues, we could see silver test 71 again, or go lower. The 17% bounce from 71 to 83 could be just a relief rally before more downside. A dead cat bounce in the middle of a waterfall. CME margin hikes took effect today. If traders can't post the additional capital, more forced liquidation comes, no exceptions. The exchange doesn't negotiate. Bitcoin at 74,500 already confirmed the weakness I predicted. If it breaks lower from here, that spreads risk-off sentiment to all assets, not just crypto, everything. Now here's something most people aren't paying attention to. $9.6 trillion of US marketable government debt will mature over the next 12 months, the most ever. This is double the number seen before the 2020 crisis. It accounts for 33% of all outstanding debt, one of the highest percentages in history. Most of this debt must be refinanced at significantly higher interest rates. The US debt crisis is hitting a new level. This creates systemic stress that could trigger more selling across all markets. We're watching the everything bubble pop in real time. The S&P 500 is trading at its most expensive valuation multiples in history, higher than 1929, higher than 2000. A mean reversion there is terrifying, but expected. It has to happen eventually. History tells us that during a deflationary crash, like 2008 or March 2020, metals get dragged down with equities initially. When the selling in metals stops, but equities keep falling, the bottom is in. Until then, the deleveraging will be brutal. That's the bearish scenario for the New York Open. But here's the bullish case, and this is where it gets interesting. The bounce from 71 to 83 is holding in pre-market. If New York opens and this bounce continues, we could see silver regain 87. even test $90 by end of day. Sharp drops are designed to trigger fear. That's how markets shake out impatient money. Gold and silver just saw a pullback, but the macro backdrop hasn't changed. Debt, deficits, geopolitical tension, monetary uncertainty, all still there, all still getting worse. Corrections are normal and healthy. Volatility does not equal trend reversal. Silver is nowhere near a top or bubble. It is severely undervalued versus stocks. Let me show you the ratio analysis that proves this. Gold to silver price ratio is currently 57 to 1. The historical ratio is 15 to 1. COMEX vault ratio is 1 to 12. Mining production ratio is 1 to 8. LBMA vault ratio is 1 to 3. Available above ground ratio is 1 to 1. Every single ratio points to the same conclusion. Silver is the most undervalued asset on the planet right now relative to gold, relative to stocks, relative to everything. Fundamentals will take over the pricing mechanism soon. When that happens, silver explodes higher to catch up to these ratios. That's not opinion, that's math. People need to understand that in Western gold and silver markets, there are more paper claims on metal than there is real metal. This sell-off is paper dumping to fool the masses into avoiding metals when the stock market collapses. Look at how unstable gold is, but physical buyers know better. Singapore Qs, Australia Qs, China and Hong Kong sold out with wide premiums. JD.com 95% premium. This is physical overwhelming paper in slow motion. Bank of America's bull and bear indicator registers one of the most bullish readings in history right now. From a contrarian perspective, extreme bearish sentiment often marks bottoms, not tops. For those who saw value in silver at 120 last week, the current price of 77 to 83 could represent a significantly improved risk-reward proposition. That's the opportunity being presented by this volatility, if you can stomach it. So what am I watching when New York opens? 5 things. And I need you to pay attention to all 5 because together they paint the full picture. Number 1, does the bounce from 71 to 83 hold? Or does it fail and we retest 71? This is the most important question right now. If the bounce holds and builds into the New York session, the worst could be over. If it fails within the first hour and we gap back down towards 71 or lower, more pain is ahead before the bottom forms. Number 2, does Bitcoin stabilize at 74 to 76,000 or does it break lower? Now we see if the selling is done or if more comes. Bitcoin is our leading indicator. It told us this crash was coming. It will tell us when it ends. Number 3, do equity markets stabilize when they open? Or do they gap down hard and drag metals with them? If the S&P opens lower and keeps falling, metals get dragged down too in the short term. That's how liquidity crises work. You sell what you can sell, not what you want to sell. Number 4, does the Shanghai premium hold at 22% or does it compress? If it compresses toward 10% or lower, that signals physical demand is weakening. That's bearish. If it holds or expands back toward 30 to 40%, that signals physical is strong and paper is losing control. That's extremely bullish. Number 5, do we get any news on bank stress, government shutdown resolution, Iran tensions? Any of these could move markets violently in either direction. The government shutdown is unresolved. Bank stress rumors are circulating. Iran is still a wild card. Where does this leave us? Let me be direct. Number 1, physical and paper are completely disconnected. Singapore and Australia queuing to buy as prices crash. China and Hong Kong sold out. JD.com 95% premium. Silver still in backwardation. SHFE vaults stable. This is not a fundamental breakdown. This is paper manipulation and forced liquidation. While physical demand increases, the divergence between paper and physical is growing, not shrinking. At some point, one of these markets breaks. History says it's paper that breaks, not physical. Number 2, the New York session will tell us if 71 was the bottom or if more selling comes. The 17% bounce to 83 is encouraging. Gold up 7% from lows, silver up 15%. But we need New York to confirm. If the bounce holds and builds, the worst could be over. If it fails and we retest 71 or go lower, more pain ahead before the bottom, watch the open closely. The unresolved tension is this: silver hitting 71 with a 17% bounce. But does New York confirm this is the bottom? Or is this just a relief rally before more downside? Physical markets are screaming strength. Qs, premiums, backwardation, sold out dealers. Paper markets are screaming stress, forced liquidation, margin calls, wash trading. Which one wins when New York opens? Do your own due diligence. Understand the risks. This volatility is extreme. Leverage trading in these conditions carries exceptional danger. Think for yourself. Use your own brain. Don't follow blindly. Not me, not anyone. This is real risk. While some are observing a significant divergence, where paper market selling contrasts with physical market tightness, it is critical to interpret this carefully. The recent low of 71 may present an entry point for some. but it could also simply be a pause before further decline. New York will tell us, stay sharp, watch the data, invest with logic, not hype. Drop a comment below, tell us where you're watching from, and tell us what you think. Does this bounce hold, or does 71 break? This is Mark from GoFinance. The next 2 hours will give us the answer. I'll see you in the next one.